Gives me great pleasure to bring on board none other than my very dear friend Mark Mobius on ETNOW. Mark, fantastic to connect with you again, my friend. How you been? Hope things are fine and well at your end. Which part of the world you're joining us from today?
Things are going very well. I'm in Dubai, the United Arab Emirates, and the policies by the UAE government are excellent. We're able to move around. Of course, we wear masks and we're able to travel. So it's one of the best places to be during this pandemic period.
Some kind of a record because I've never ever interviewed Mark Mobius from the same place twice. Last time you were in Dubai, this time also you're in Dubai.
Yes, exactly. Of course, I've been traveling between that. I've been to Turkey, I've been to Cyprus and to Egypt, but I can't go to Singapore. As you know, I have a place in Singapore I want to return to, but it's impossible now because of the COVID situation.
Well, hopefully soon, hopefully soon. Mark, we are in a good spot if you are an Indian investor. We have done rather well this year. The gains have been double digits. But if I look at the world around us, there is a currency crisis in Turkey. Korean markets have plunged to a new record low. Hong Kong, as we speak, is at a fresh 12-month low. So the world is shaky and Indian markets have done rather well for themselves. So do you think this kind of an outperformance what Indian markets have exhibited is real and is here to stay?
Well, it's real. That's no problem about it. And thank God for the Indian market because, as you know, we have a heavy weighting in India, and our funds have done very well as a result of India and Taiwan. So those two countries have done very, very well. And look, you have to realize that a bull market is not over till it's over. In other words, you have to assume that the bull markets will continue unless there's some good reason to believe that they will not continue. And if we talk to the companies in which we invest in India, we see that they continue to do very well in their earnings. They're growing, they're innovating, and we believe that there's no reason for us to panic or get out. Even if the market goes down, we probably would buy more of what we have. So I think we have to assume that things will continue to do well. Of course, there'll be short-time corrections, maybe 10, 15% corrections along the way, but these will be minor corrections in an ongoing bull market.
This leg of decline in Indian stocks, 10% on the index, 15-20% in individual stocks. Are you a buyer?
Yeah, we are continue to look and buy Indian stocks. Of course, in our funds, we have certain restrictions on how much we can buy in any one company or any one country. But we're up there, 20% plus in India. So that's quite a big weighting.
Mark, given that the difference between Indian markets, and I'm using valuations for reference purpose, and I'm looking at 1 year forward, the gap between Indian stock markets and the Chinese stock markets, the valuation difference between, let's say, Korea and India, that's very large. I've been told that this is an historical gap like never seen before. Isn't that tempting enough for a global investor like yours to reduce exposure to India and go to other markets which have underperformed and which in a sense offer better entry points?
Well, there's no question. Yes, China has really come down a lot. And of course, this will continue because the government is continuing its reform program, which will affect a number of companies' industries. Now, we are in China. We are invested in China, but we're not in the large companies that are vulnerable to government regulation. We're in the medium-sized and small-sized companies. And we're finding opportunities in China, but we find that the opportunities in India are actually better. The companies are more responsive. The corporate governance has improved dramatically in India. They're very much aware of what we think is very important, ESG and culture. So all these things combine to make us a little bit more optimistic about our holdings in India rather than China. But we're not ruling China out by no means. We continue to look at China, but we just haven't found the terrific bargains that we can see in India.
I'm also happy to share with you that our Hindi channel that is also live with this interview. So maybe you want to say hello to all our ETNOW Swadesh viewers also.
Hello, everyone. Hi.
Maybe a greeting in Hindi would look better, Mark. Okay. Mark, you said that you like China, but you are still inclined towards India. So, what is your sense for 2022? Are we in for another year of good double-digit returns? Because 2020 was an aberration. First you fell and then you recovered. So I'm keeping that aside. But 2021 has been a year of absolute good returns from a decent base. Could that continue for 2022 also?
Yes, it could continue. The interesting part of all of this situation with COVID is that, as you know, a few months earlier, the Fed in America was saying, well, look, now it's time for us to tighten up and to increase interest rates and so forth and so on. Now, with the threat of a new variant, they're having second thoughts. Now, when that happens, of course, it means that the party is not over because we continue to see governments pump money into these economies, and we continue to see them trying their best to maintain a healthy economy with low interest rates. So this kind of situation is actually good for the markets. It's very ironic. On the one hand, you see COVID cases going up, but you also see the stock market going up at the same time. So that's quite a interesting thing that you got to think about. You can't see the COVID situation as necessarily bad for markets because government policies arising from COVID actually are beneficial to markets.
Are markets secretly pricing in tapering whenever it starts?
Well, that's the question mark. Tapering was uppermost in the minds of people just a few weeks ago. Now it's fading into the background because there's a realization that perhaps the Fed will take cognizance of this new variant of COVID and maybe will not tighten the screws as much as we expect.
So, Mark, if the COVID variant spreads, could be in for a severe correction or a minor correction? Because when COVID was discovered, that time markets just went through an excruciating fall. Hell broke loose. Markets were down 40-45% across the board. If the COVID variant spreads, what happens then? How do you think markets would adjust?
Well, as you know, when last year when this COVID situation hit, there was panic. The market came down dramatically, but recovered very, very quickly. This time around, I think people are inured to the bad news. In other words, they've been hearing COVID, big disaster, big problems, blah, blah, blah. And now they're beginning to say, well, wait a minute, last time it wasn't so bad, the market did well, so why should I panic with this situation? And by the way, the news coming out of South Africa is that, yes, the new variant is highly contagious, but is not necessarily fatal. In other words, the deaths so far are very, very minimal. So you may find a situation where people will begin to realize that this new variant is not as serious as some people believe. But nevertheless, people will tend to not react as strongly as they did in the first panic.
First, we spoke about your India exposure and it was limited to 3 stocks. Have you made it 4 or 5?
No, we're sticking with those stocks and we are very happy with them. Of course, we continue to look at what the possibilities are, but so far we're not making any changes.
But these are mid-cap stocks. Any reason why you, let's say, opted for a persistent, not a frontline name like TCS or Infosys?
Yes, the whole idea of our fund was to be different from the index. As you know, nowadays, index investment is very common. The exchange-traded funds, ETFs, are the instrument that many investors are using. And of course, those ETFs are based on indexes. So in order for us to offer anything different from what people now have, is to do something where the index is not involved. So we make a point of not investing in companies that are in the index. I think in our portfolio of 30 stocks, maybe 2 are in an index and not the main index. So that's one of the overriding principles that we have in our portfolio. The second thing is that we want to go after medium and small size companies that people have not noticed. In other words, that other people are not into. The idea is to see these companies grow and see gradually other people recognizing the value of the companies. Of course, then the prices will go up.
But Mark, 2 stocks which you own, one is Polycab and the second one is Apollo. Both of them in a sense are commodity consumers at a time when we are seeing a serious re-rating in the entire commodity complex and companies are struggling with maintaining cost and which is having impact on their margins. Does it make sense to bet on commodity consumers and not producers?
Not necessarily. If you look at, let's say, looking at the tube manufacturing, yes, they're using steel and steel prices are up, but it's only one part of their overall costing. The other part, of course, is labor and all the other aspects of manufacturing. So the impact on pricing is not that great. The good news, in addition to that, is that with the Apollo quality...
Flashes stop.
Excuse me?
Mark, go ahead, please.
Sorry. With the Apollo quality, they're able to get a premium price. So they can raise prices without having too much of an impact on demand. So it really depends on the individual company. You'll find that a lot of these commodity consumers are continuing to do well simply because the demand for their products is so intense and their quality is so good, they're able to maintain the market whilst raising prices.
So do you have a price target in mind when you bought Persistent or Apollo or for that matter Polycab?
Well, that target is always changing simply because companies increase earnings and it's a continuing situation where you have to constantly monitor where the company is and where it's going. So a price target today is not a price target tomorrow because the situation may have changed with the company. So it's a very dynamic situation. And one of the things that makes investing so interesting and difficult, by the way.
But as of now, you believe that there is no reason for you to get worried about your India exposure and the 3 stocks you own, given where valuations are and given where commodity and inflationary pressures are coming back.
That's right. We only worry about one thing, the companies in which we invest. In other words, what is the situation with the company? Of course, what is the macro environment impacting them? Of course, we have to look at that. But generally speaking, we focus on the companies, how are they doing? And we're not really focused on the index or what ICICI is doing or what Reliance is doing. We're really focused on those companies in which we invest. And we find that the price behavior differs from these companies and others.
Are you surprised with the kind of IPO euphoria or excitement we've seen off late in some of the new tech companies, especially names like Zomato and Paytm? Have you looked at them or have you given them a complete skip?
We've given them a skip for 2 reasons. One, we tend to not go into IPOs because too often they are perfectly priced. In other words, their prices are not necessarily a bargain, okay? The second thing is that, as you know, many of these IPOs, particularly in the tech area, are built on hope and forecasts, while the company is still losing money. And we do have a policy of not investing in companies that are losing money. Now, of course, yes, prices could go through the roof when people are excited about a certain technological innovation or excited about the company and their hopes and fears. But at the end of the day, we find that it's better to stick to companies that have a solid foundation, low debt, and good earnings.
Mark, a very popular trade for global investors who invest in India is to buy private banks or buy into financials. Why have you given that a skip?
Well, first of all, you'll find that the financials often are in the index. So we're avoiding index stocks, number one. Number two, banks are quite opaque. In other words, it's often difficult to find what is happening with the banks. So if you go into a bank to interview the management, you say, look, how many bad loans do you have? They're not going to tell you what is actually happening because they don't want to look bad. So they may say, look, our non-performing loans are 2% or 3%, but in reality, they probably are more like 20%. So it's this kind of opacity which makes it very, very difficult to invest in banks. And you have to be extremely careful. So those are really the two reasons why we tend not to favor banks. Now, it doesn't mean that we're not going to ever go into a bank, maybe a small bank that's growing very rapidly for one reason or other and is very solid, and where we can get the information that we want. But otherwise, you have to be very cautious.
Mark, I'll phrase my question, next one rather carefully because I'll request you to divide it in two parts. At the current juncture, in India, what to your mind is in the buy basket, in the hold basket, and in the sell basket?
Well, the buy basket is very clear for us. We want companies with low debt, companies that have a high earnings per share growth, and companies that have a high return on capital. Those are three important financial aspects. And then in addition to that, we want companies that have high scores on ESG, environmental, social, and the corporate governance, in addition to culture. So with those characteristics, that would be in the buy basket. Hold basket are those companies that we have those characteristics and where there has been no significant change, so we want to keep on holding. And the sell are those companies that don't meet those characteristics, that are losing money, that are declining in their earnings, and generally speaking, have too much debt.
And globally, Mark, what will qualify in the buy, sell, and hold basket? If you have to take asset class view.
Well, it's interesting when you look at asset classes. You may say, hey, I want to go after tech stocks, or I want to go after medical stocks, or I want to go after industrial stocks. Actually, at the end of the day, it doesn't really make that much difference as long as the company is performing. So you can have a company that has those characteristics that I just mentioned, and they could be like Apollo in an industry, an industrial company, or a company in Taiwan that does the semiconductor software, or a company in India that does medical testing. So it can be in any industry as long as they meet the characteristics that we are looking for. So we don't like to categorize industries as a no-go or a go, but we want to categorize them in terms of their characteristics and their ability to earn money and to have low debt.
No, when I say asset class, Mark, I was specifically talking about, would you buy gold? Would you buy Bitcoin? So if you have to look at a buy, sell, and hold for various asset classes, how would you classify them?
Well, gold, as you know, I believe that people should have some gold, maybe 10% of their assets for emergencies. Gold is a currency throughout the history of mankind, and it's something that you can have. Bitcoin or cryptocurrencies are I would say, in the class of religion. It's a belief. They will go up if other people believe the way you do. But otherwise, it's not an investment. It's not something that earns money, that pays dividends, that produces something. Even gold, people say, well, cryptocurrencies like gold. Oh, no. Gold has a use. it's not only a currency, but it can be used in industrial purposes. I was just talking to a semiconductor manufacturer, and I said, have you ever used gold? He said, yes, we love gold for connecting semiconductors. But the problem is its price. It's a little bit too high. But if it comes down in price, we will switch from copper to gold because gold is far superior to copper. So that's the reason why, I really don't think the cryptocurrencies is in the category of viable investments. It's a speculation. You can play with it, you can have fun with it, but don't consider it an investment.
Two more questions, Mark. Given the kind of re-rating some of the EV companies have seen, as long as you can convince markets that you are in the EV business, the stocks are getting re-rated. Doesn't matter whether you are a car company or a battery company or a IT company which is making projects for the EV space. You need to be in the EV space. Do you think there is a bubble in making in the entire electric vehicle space?
In some cases, there is a bubble. Everybody's rushing into that space. As you know, there are new electric car companies being listed or formulated. Everybody and his brother seems to be interested in that area. Of course, it's like, the gold rush in California many, many years ago. The people that made the money were the people selling shovels and tools for the miners. And that's probably true of the EV area. People that are making, let's say, components of batteries or certain gear shafts, that sort of thing, will probably make money, but a lot of the car companies will not do very well.
Mark, final question. What is that one data point or what are the sequence of events or chain of events which you would monitor closely, which will convince you that it's time to sell or exit your India portfolio? What I'm trying to understand from you is that will it be valuations, will it be events, will it be China coming back? What would be that important, canary in the coal mine, if I may use that phrase, which will convince you to sell or reduce your India exposure?
The most important thing, of course, would be government regulation. In other words, if, for example, the Indian government says, look, we are now going to impose a big tax on foreign investors, or we're going to limit the ability of foreign investors to remit their earnings, things like that would, throw us into a panic and be a great concern to us. So I think that would be the number one problem. Other things like problems with earnings, company characteristics and so forth, we can handle that. We can work with the companies or we can sell companies according to what we think they're going to be doing. But generally speaking, we tend not to turn over our portfolio very much. We have very, very low turnover because we have companies that we believe in and we know that are going to do well over the long term.
Mark Mobius, always a pleasure to have you on ETNOW. And I certainly hope to see you in person very soon in India. And here's hoping that we meet you. Stay safe and have a wonderful, time in Dubai.
Thank you very much. All the best.